Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, jumping right into what happened in February, we saw some strong performance for the second month in a row. All major indexes did very well, with small caps doing the best in February and also lead the way in 2019. These first 2 months of the year have been the best start since 1991, and investors have recovered quite a bit of the losses from the fourth quarter problems. With that said, bonds are still struggling to keep their head above water, but after the 10-year interest rate fell from a high of about 3.25% to a low of 2.5%, it's not surprising to see yields back up a little bit. Turning to sectors, we saw the most beat-up sectors of the fourth quarter recover nicely: communication services, materials, consumer discretionary, technology, and industrials, even financials and energy. All in all, there was very little to complain about so far in 2019. Here we have a chart of the S&P 500 index over the last year. Clearly, it's been a bumpy ride, but things seem to have settled down a bit. As bad as the fourth quarter sell-off was, we're now back to October levels, and it appears the market is back into a more reasonable range. That said, we obviously had a huge overbought situation in September that began the problems of the fourth quarter, and then we saw a very, very oversold environment in December. The question today is whether we're preparing for a breakout higher, or are we going to retest the lows of December? I'm having trouble finding a catalyst that's going to propel us to new highs, but that doesn't mean we can't grind higher. The key today is to quantify the risk in the market so that you don't end up giving back all the gains for the year. We can't manage the returns, so we can only manage the risk. And as many of you already know, I'm always concerned about downside risk and how to protect clients against huge sell-offs. And that's why I manage money using both strategic and tactical positioning. This month, however, we're only going to focus in on the tactical side, which represents my outlook over the next 3 to 6 months. Okay, so to manage risk, you need to understand what you can control. I can control what underlying security to buy. I can control the holding time of that security. I can control how much upside I'm willing to sacrifice to protect against any downside. So let me kind of show you how I go about this. This line here represents your investment break even. Anything above this line is a gain, and anything below it is a loss. This line here represents a zero gain loss for the S&P 500 index. Anything to the right is positive, anything to the left is negative. Obviously, we all like positive gains, right? But in order for us to protect to the downside, we're going to need to cap how much we're willing to take on the upside. By sacrificing some of this upside, you can significantly protect yourself from the downside. This line here indicates no loss on your investment if the S&P 500 falls by a certain amount at the end of your holding period. We're going to refer to this here as the buffer zone. Once the buffer zone is exceeded, the investment will begin to lose money if the S&P continues to fall beyond that. Given where we are today, I've allocated about 40% of my stock exposure to this strategy with expirations of 3 and 6 months. Why? Because the risk-return profile is quite attractive. So let me kind of walk you through that. Here I have cap rates that range from 7.5% to 11.5%, depending on whether they expire in 3 months or 6 months. That means that if the S&P 500 rises 5% by expiration, I'm going to get all of that return. If it goes up by 20%, however, I'm going to be capped between 7.5% and 11.5% and give up the remaining upside. On the flip side of that, I have buffers in the range of minus 11.5% to minus 25.5%, depending on the expiration. As an example, if the S&P 500 falls by 10% at expiration, I'm fully protected. If the S&P falls beyond my buffer at expiration, only then will I begin to see some losses. I'm willing to give up some of my upside for protection against these big losses. Given my outlook, which we're going to be talking about here in a minute, I'm more than happy to cap my gains over the next 3 to 6 months in order to protect what we've already made. Look, if I'm going to be wrong and the market rallies another 15% from here, I'm fine with missing out a little bit to the upside. I'd rather miss a small amount of the upside than to see my clients lose 10 to 15% by ignoring what's going on in the market. There are plenty of buy and hold strategies out there, and if clients just want to close their eyes and ride the roller coaster, that's fine. I just think managing risk is more important than hoping for returns, not knowing where they're going to come from. Okay, so most of you are familiar with my four-part framework for making investment decisions. So let's just jump right into this and run a quick check of our card to make sure we're all on the same page. The economy looks good. We have subdued inflation. Employment is good, but there are signs of weaknesses showing up. Atlanta Fed recently issued an expectation of GDP in the first quarter to grow at only 0.3%. And it's still too early to know what the real effects of the Fed rate hikes and the balance sheet unwinding are going to be. We certainly don't see a recession, but we do expect continued softening in the economy throughout 2019, so I'm staying neutral. Earnings season just wrapped up and the numbers are good. However, we did see revenues a bit on the soft side, and companies that issued weaker forward guidance saw their stock prices get crushed. Valuations have gotten a bit pricier over the last 2 months given the rally and are now back to levels we saw in October of last year. While low interest rates may make valuations more attractive, the question is what's going to go ahead and cause the PEs to expand going forward if earnings are growing slower and the economy softens. Being neutral here is simply saying that things aren't overly expensive, but they aren't cheap either. Look into the markets. We all know how well it's been this year, but is this simply a bounce back from a terrible fourth quarter, or is this market really ready to propel to new highs? I think the market's a little bit too optimistic about a potential trade deal with China. Just assuming that a trade deal does get done, it's still going to need approval by Congress, and it's going to take many, many months before we see any benefits. I guess the one thing that it will do is take at least one concern off the table. But remember, markets are always going to find something to worry about, so this will just be another stepping stone. Obviously, all four of my components here lead me to a neutral outlook over the coming months, and that's what's really forced me to take a look at alternative opportunities like the one we just finished talking about. So given my outlook and what we're doing in our clients' portfolios today, what should you be looking out for? First and foremost, I wouldn't get too complacent. Too many investors took all the pain in the fourth quarter and may have panicked. And while we had a great recovery since then, it's not time to simply jump in with both feet because you're feeling better about things today. I also worry that many investors may have a little FOMO on their mind, fear of missing out. If you missed this 2-month rally, you need to reevaluate your strategy so you can be better prepared in the future. Playing catch-up is a dangerous game. Sit down with an advisor and discuss an investment strategy that fits your needs so that you don't find yourself chasing returns to try to make up for not being prepared in the first place. And I guess now is as good time as any to go ahead and rebalance your portfolio. We've had a significant run-up. You may have skewed your portfolio outside of your risk tolerance, so take this time to make sure that you're comfortable with the risk you're exposed to. Again, speaking with an advisor can help you understand what will happen to your money in different economic scenarios, and I encourage you all to reach out to an investment professional for guidance before making any investment decisions. And finally, if you've quantified your risk over a certain time frame, I think you'll have a better idea of what outcomes to expect and how those are going to impact your returns, and that's going to really let you sleep better at night. If you're just looking to historic returns to make decisions, don't be surprised by any outcome. Like Confucius said, success depends upon previous preparation, and without such preparation, there is sure to be failure. Thank you all for watching our video. I hope this video was helpful, and if you have any questions on anything in this video or just want more information on our investment strategies and models, please don't hesitate to call me or email me, whatever's easier. Thanks again for watching, and I hope to see you next month.